Okay, welcome. I'm Karen Moreno, the Fund Administrator at Mathers Associates. And thank you all for joining us here today for the first in a series of conversations with our investing partners. I'd like to take care of a couple of pieces of housekeeping before we get started. First, we invite everyone with any questions they may have to participate. Just use the link at the bottom of your Zoom screen where it says Q&A. Feel free to submit any questions there. If time permits, we'll do our best to address them at the end of our conversation or email you directly after the webinar. Second, we anticipate this conversation to run between 30 and 60 minutes. With that, I'd like to introduce Elliot Zeelander, Managing Partner of Mathers Associates. We hope you enjoy our presentation. Elliot, I'll let you take it away.
Thank you so much, Karen. I'm grateful I remembered to unmute myself. On behalf of Jack Bellapede, Karen Moreno, Andrew Chan, and myself, the whole Mathers team, I'd like to introduce our guest today, Dave Thomas. He is the Senior Managing Director for Raymond James since 1987. As a bit of background, Dave has always been a hard worker and overachiever. Dave was an academic All-American left fielder for the Spiders at the University of Richmond, a career 300 hitter, but I need to point out a 375 hitter his senior year. Dave then earned his MBA and JD with honors from Emory University. Dave has served as the head of investment banking and mergers and acquisitions at Raymond James since '87. From 2000 to 2002, Dave served as the CEO and chairman of Safety Clean Corp, a $2 billion environmental and industrial services company during its restructuring. And now Dave and his partner, Gene Ostro, lead Raymond James Private Equity. We've had the pleasure of investing with Dave for over 20 years. This was a relationship that my dad, Norbert, first cultivated, and one that I'm very grateful for. And the relationship continues to grow. So Dave, it's awesome to have you with us today. Why don't we get started with an easy question? You've had a long career, not that long, but long enough career. What got you interested in working in this in the first place, and how has that evolved to bring you to where you are today?
Well, thank you, Elliot, and it's good to be here, and nice to be able to have this chat with you and in front of your partners and your partner group and your management team. As you pointed out, I got a joint law and MBA degree and passed the Georgia bar, and I had been working in an investment bank, a small boutique at the time, financing early stage growth companies and some buyouts, and decided that rather than go to work for a large law firm, that I really enjoyed investment banking and private equity, and that career started back in the early '80s and has continued through the time I was recruited to Raymond James and to the point where I took over their private equity business back in around 2002. So it's been a fun ride. It's been very rewarding, and those of you who know our firm know that the firm has been quite successful and well managed. And so I work with a great team of people. Got a great partner in Gene Ostro and a great supporting staff at RJ.
Awesome. Yeah, it's been a lovely relationship. From you and Gene to Cindy and Chris and everyone else we've always dealt with. It's just been sterling. First question I'd like to ask, how do you find investment opportunities like these, the different ones that we're in?
Well, I would like to tell you that we have a real secret sauce, but there's nothing that is beyond common sense and hard work. We have leads about businesses that come from all walks of life, from inside the firm to ourselves and our relationships to people we meet. At the end of the day, what we try to do is lock in on a business that we find very attractive and intellectually stimulating, and then we'll go search out all the businesses that compete with it and rank those businesses, and then go to the industry shows and meet the industry experts, and we'll see how the reputations stack up. And then from that, we'll develop our target list, and we may buy the company we first heard about, and we may target one of its competitors. So that generally, that's the process that we go through, which is a lot of shoe leather. It's a lot of trips to Vegas, Orlando, New York, Chicago to go to these trade shows. And we visit the companies incessantly. I should point out that we are a firm that avoids auctions almost at any cost. And we believe that we need to get to know a company. We need to know the management team and the ownership. And the way we get our hooks in them is we try to help solve some problem that we identify that they have that perhaps is between them and more significant value.
Okay.
It's a consultative sell.
Yeah, I know you manage a few companies right now. So are you looking for new companies or not necessarily on the lookout, but always the radar is out there?
Yeah, we're always looking, reading. We haven't attended conferences recently, but we're typically at conferences that we find, interesting, and we've been told that there might be good opportunities at. And so, yeah, we're always looking, although at 64, and Gene is 68, while we're still very young, these opportunities in our way of looking at them typically last 8 to 12 years. And so you do have to start projecting out and ask yourself, how long do you want to be a fiduciary for other people's money? Yep. And so we've been very careful about what we've committed to in the last 3 or 4 years.
Yeah, that's interesting. I just want to give a shout out to our friend Larry, who's out there, who hopefully can hear us soon. I'm sure Karen and Andrew are diligently trying to help him. Do you have foundational requirements? Are there things you're looking for that you need to see? And what are they?
Yeah, we do. And again, I'm a great devotee of Warren Buffett. And that's Berkshire Hathaway is one of my largest personal family holdings. So I'll just say that we try to buy things that we really like and don't mind owning, not for life, but for an extended period of time. We see a long opportunity. But at the core, the businesses have to be understandable to us. We have to understand, what the purpose of the business is, how it delivers its product or service. It has to be a predictable business. We're not interested in companies that make 1 sale or 2 sales a year. We like companies that are predictable and have a rhythm to them, a rhythm of necessity to a customer base, a rhythm of value added that's repetitive. And typically smaller transactions form the underpinning of the economic model. Our structure is something that we have to be able to sell to the owner, because we are committed to putting our clients' capital in a preference position. And not all companies or owners are understanding of that or willing to accept that the new money has to come out first. And I should say, the ownership and the management team that we're going to partner with, if you will, has to be students of the business. We have to feel like they they take great pride in what they do, and that they have great respect of their people and their colleagues and their customer base. So it's a reputational thing that is very important to us. And the last piece is we have to conceptualize how and at what multiple or value we might be able to exit. It's not necessarily specifically who we're going to build the business for, but categorically at least, we have to have a thematic approach to an exit and what we believe the value will be at the time we decide to exit.
Okay.
So those are the basics of it. We're industry agnostic, although we don't invest in gaming or gambling or anything that might reflect negatively on our partners.
Okay. Do you, when you're looking at the companies, are you looking for smaller companies? What sort of structure are you looking for?
Yeah, our typical company is small enough that it has not hit the institutional radar. So it's important to us to be able to, again, as I mentioned, our approach is to get to know the owner and help him or her figure out what's between him and her or her and unlocking value in the market opportunity that they have. And that can come in a number of different flavors. Those problems can be capital, they can be human resources, they can be reputational. Many times we get involved with these smaller companies, there's some problem. There's some problem that's nagging at them. And in almost every single case, it's been a lack of capital availability. We've had to unwind structures that one company we bought was built on 10 different partnerships and had never been audited. And so we were willing, because we loved the business and we had struck a very attractive deal, we were willing to go through and audit all those businesses ourselves and consolidate them and negotiate with the individual partners in each one to get control of a company that otherwise wouldn't have been available. And so, I think these days, unless you're willing to just be the high bidder in an auction, you have to have a shtick that allows you to win favor with the owner. And we've decided, and it's always worked for us to find the owner that and help them understand the challenges that they face, and that we can bring the solutions to bear, and that they win and we win.
Yeah.
And that's been our style. That's been our strategy from day one.
Yeah, and you mentioned it before, not going into auction situations, and that's the same we see with all of our other private equity partners. Sourcing deals themselves, people coming to them based on their relationship, their reputation out there in the world. And then you mentioned Warren Buffett. He's not out there ever auctioning. If somebody wants to come to him to sell, great. If it's open to an auction, move on. Go have an auction. Good luck.
I think at the end of the day, we only have so much time, and time is our most valuable commodity. We've always been fortunate that when we identify a transaction, we've always had more capital than we needed to close the transaction. So from our perspective, we don't want to waste a lot of time chasing something in an auction. If somebody is very interested in us, we will negotiate a very attractive price for them. And typically, and we've said to people who have asked us or invited us in to auctions, and we've been successful. We said, look, we're not going to participate in the auction, but if you'll tell us what price we need to pay, we'll let you know, yes or no, up or down, right now.
Yeah.
And it's worked. And we had one tell us, just here's the price. We want you. We want Raymond James. And we said, well, that looks fair. We'll do it.
Yeah, that's awesome. That's awesome. Just like time, we only have so much time. There's value there. What do you look for in management? When you're making the acquisitions, are you looking for management that's already there, or are you
Yeah,
more likely,
generally we find that
teaming?
we find it in these smaller entrepreneurial-led attractive market opportunities, companies in a good position, but it's got challenges, is typically because the owner is not fit to run the company long term. So that's a level of honesty that you have to share with people, and you either get through that or you don't. And you're aware of some of our situations, and we've always changed the management at the top within 3 years, and usually that's what they want. We're gonna write them a healthy check, and they're going to retain some nice stake in the business, but they're typically realize that the day-to-day is not what they're really suited for, and they want to be. And I asked them the question: Do you really want to report to me and Gene, or would you rather be at the table with us and let's have Mr. Professional report to the three of us? And that's sort of they said, yeah, I get it.
Yeah,
I really would like to sit on your side of the table. I said, well, then sit down here and let's get the right person. It's probably going to take us 3 years because we don't want anyone that you wouldn't be proud to have run your business. And it takes a while.
yeah.
So yeah, it's typically a 3-year transition.
Okay. Yeah. And like you said, that's what we've seen, and we see it across the board. Every once in a while, there's a unicorn out there, an entrepreneur who can go the whole way, but
oh yeah,
and it's nice for them to be, like you said, to be able to step aside and let somebody else run it while continuing to oversee it and continuing to own a nice chunk of the business. So it's in their best interest to.
And we find that they stay active. They just have a different role, and we try to tell them, don't you think we like what we do? Wouldn't you like to do more like what we do?
Yeah.
We're having fun, and I don't. It's not fun to report to us.
Yeah. So now that we've changed management, and we know we're 3 years in, what sort of exit strategies do you guys look for?
Almost always a trade sale to a strategic buyer. Not always, but we are people who believe we look for CEOs with a lot of cash on their balance sheet who are strategic to the business we own and who need earnings growth. And those are our ducks on the water. They're the ones who are under pressure from their public shareholders, their board. They've typically done some public financings or debt and equity or both, and they need to buy growth. And so it's typically those parties who will pay the highest price. And we're generally, when we yield control, we want to get out. We have kept very small stakes in companies, but we're not people who sell when the market is not offering us full value. So if the market doesn't offer us full value, we're not trying to cobble together some deal where we keep an earn out or a stake in the upside. We're either going to sell into strength or we're going to keep building.
Yeah. A company we were both invested in together, Albion, that sold to Greer, I believe. And was that how this situation worked out? They needed our product, our company.
Yeah, that's an interesting situation. I'll dwell on it a bit because it speaks to how we operate. So many people spend a lot of time and are as good or better than we are at generating deals, and they buy a company. But while we own the company, we spend a lot of time having dinners and lunches with prospective buyers. And so in that particular case, the buyers were all overseas. And so we went to Stockholm and Paris and other places in Europe, visiting the likely merger candidates. And because of the structure of the European market, those were bigger companies than we were, although we were more profitable. And so we courted those relationships. And interestingly enough, the company that bought us, the CEO for 10 years told us he didn't need us. And then his company got sold to a large Swiss investor, and they invited us over for a meeting in Paris. And we sat down, and the Swiss investor said, well, we'd like to talk to you about buying your business. And I said, well, I'm flattered, but surprised. He said, why are you surprised? I said, because for 10 years, your CEO's told us he didn't need us, and he was sitting there. And but we're pleased there's been a change in thinking. And there was a little uncomfortableness on the other side of the table, and we had a good meeting, and then we left and flew home. And the CEO was fired within 2 weeks, and because I guess he had fought the idea again, and they said, look, it makes all the sense in the world to consolidate the U.S. market opportunity. And so that began a negotiation, as you know, and a very good outcome for all of us.
Yeah, it was, and in a little while we'll get to one of our businesses that was spun out of that. But before we get there, what do you look for in your investors? What do you want from me? What do you want from the other investors? What do you want less of from me?
I think that's an interesting question, because our style of doing business is we take the deals down with Raymond James reputation. And interestingly, even though Raymond James is only a minority of the capital, significant minority, but a minority of the capital, I've never had a seller ask me where the money is, because we represent Raymond James, and they always say, oh, well, okay. So our style is as a merchant bank, because the firm uses these investments to enhance its relationships with people like you and your firm. And we cultivate investor relationships in a number of ways, but having these stakes available in companies to buy is something that we view as an attractive thing to offer. And so what are we looking for? We're looking for people who understand that private investing is not a straight line, and that you have to be patient, that we're going to communicate as accurately as we possibly can, and we're not going to exaggerate where we think we're at. And when we sell, it will be because we believe that the time is right and somebody's willing to pay us for the asset that we own. And I think we like investors who dig in and want to understand what they own, because those are the people that tend to you have intelligent conversations with, and you're not trying not to take their call. You're trying to take their call, because the conversation is going to be meaningful. And secondly, I think in everything we buy, there's usually almost always a second or a third or a fourth round, because we are buy and build people. And so we're looking for partners who can participate in subsequent rounds and who go into the investment understanding that style and aren't afraid of it. And so you've watched us. We do this, and we raise capital judiciously, but we do raise money. Yeah.
That's interesting, because, and I'm just flipping to my internal snapshot of Salon Lofts. We invested in them. I don't really need to pull it up, but we invested with you at the end of 2012. We then invested again in 2017 and 2018, and then finally again last summer when COVID hit. So why don't we start talking about some of the portfolio companies? Tell me about Salon Law, or tell everyone about Salon Laws.
Well, I think what's important to understand, again, let's go back to the fundamentals. I mean, when we met Salon Laws, the owner, he, in this case, had developed 20 salon suite rental operations. And these are typically 5,000 square foot facilities of leased space in an attractive demographic area, female audience, where women like to shop. And these salon suite operations are plopped down. And then the job is to attract stylists to rent these private suites and conduct their businesses inside, as opposed to working in a traditional salon. And so the opportunity for them is to, for a fixed cost suite, to retain more of their revenue and generate a higher net profit.
Yep.
And so they've been growing rapidly. We found this business. The owner, as I mentioned before, had raised money from every doctor and lawyer and dentist in town, and had 10 different partnerships. None of them had the same exact ownership. None of them had been audited. And we had to develop a plan to audit these and integrate a plan to consolidate the businesses in a way that the partners would not scream and holler about. So it needed to be presented in a way that they viewed as, hey, that's fair and reasonable for what we've got here. And so over a period of 3 or 4 years, we consulted with the owner, and finally he called us up and said, I'm tired. I've just put the 10th store in. I'm exhausted raising money. I've got people calling me about, what's the next step, and I need some help. And so we quickly put together an arrangement to consolidate the businesses for them, audit them, and so forth. And then based on the resulting cash flow, we worked out an arrangement to invest. And he stayed with us, and he ran the business for about 3 years. That was a case where, he was eager to leave at the 3rd year until that 3rd year came, and we had to remind him that, we had hired a CEO, and that he needed to be supportive of that. And he did get his ducks in a row. And so we got through that. And now we're at 170 locations and about 60 million in revenue and about 17-ish million of cash EBITDA. And, a very nice business, very profitable, very predictable, 95% plus occupancy. We've been growing it at the top and bottom line at very nice double-digit multiples. So, this is a company we're very proud of, and we think has a great value.
Yeah. No, and it's amazing. I think in 8 or 9 years, you've grown from 20 to 170 stores. You've grown to 17 million in cash EBITDA from, I believe, 700,000. And earning or revenue of roughly 7 million back in 2012. So,
yeah,
it's remarkable what you've done. How has Salon Law done both prior to COVID, as far as turnover? Because I know in the salon industry itself, people are always jumping around and salons are opening and closing. And, what makes you guys so special? Well,
we're not oblivious to turnover, but the difference between us and others is we work at it every day, and we've got programs in place to mitigate and reduce turnover. So our turnover is about 20%. The industry average is about 50% in a traditional salon, and our competitors run in a suite rental business run about 30%. We know that because we visit with them. So it's a business where we provide the entire back office, a turnkey operation for these people. They bring their tools in, they hang their pictures, they put up their decorations, and they're in business. And we provide the whole IT framework for the business, the reservation system, the payment system, the cleaning, the maintenance. If they had their own salon, they're constantly distracted by all these other things that they're not good at. They're artists, and artists are notoriously inept at managing their business and at managing their money. And so there is going to be a natural turnover because they tend to be they get distracted with life, and they forget their business. And so we have coaches on the team. We call them loft owner advocates, but they are coaches. And we have to talk to them about any number of life issues, not just cutting hair, and about what their pricing is like, and whether, if they're not using the reservation system, they're not getting lead flow as a result, because we're generating with our brand and our website tremendous lead flow. But if you're not on the system, as about 20% are not, then you're not getting the benefits. You're paying the rent, but you're not getting the benefits of the entire package. So yeah, it's an effort. It's always a work in progress. It is not an easy business, as many of our smaller competitors who thought it was a real estate business have learned. And we're buying those people out right now.
Yeah. No, that segues into, primarily you've done, all of your growth has been organic.
Most all of it until the past year.
Yeah, until the past year. And like you said.
And you asked me about COVID, so we might as well hit on that. I mean, look, we lost millions during COVID. I think we lost over 5 million, and which is why we had to do another quick round of fundraising. So what happened? Well, the states shut us down. All right. And so some of our competitors tried to charge their stylists, and some of the salon owners tried to charge the stylists when they couldn't cut hair. And that just doesn't work. So we had to stop billing, and thus we had to turn to all of our landlords. I think we had 120 some landlords, and we had to renegotiate our leases, which we did within a period of about 90 days. And we negotiated abatement and rollover of the unpaid rent, just added it to the lease going forward and paid it out. We're paying it out over time, and it's worked out very well. The business snapped back once it reopened.
Yeah. And
further than that, a lot of stylists who knew about us, all of a sudden realized they didn't want to be in a salon that was wide open with a bunch of chairs and a bunch of people talking. They wanted a private suite, and their clients wanted a private suite. And so that's accelerated our growth.
Yeah. And I know it's lowered your vacancy rates, which is something you're always looking at.
Also drove a lot more of what I'll call well-established stylists to us. Great book of business, not just trying this out. They needed it.
Mm-hmm.
They needed a place to move their cash flow.
Yeah.
And so they've been very sticky. For almost no turnover of the parties we've picked up after the pandemic.
Yeah, that's really awesome. I'm looking at the time. We're at about 11:35. So I think we should move along, and we'll do a hard pivot from salons to Nielsen Bioscience. We touched on it earlier with the conversation about Albion.
Yeah, Nielsen is an interesting business. Okay, so it was tucked within Albion at the time we were selling Albion to the large Swiss pharma company. And in the course of negotiations, it became clear to me and Gene that they were not all that enamored with the non-allergy business lines that we had. And these were two small products, but they had, we think, great potential, obviously. But they were going to take them, and so, look, they paid us $300 million. We could have just given them to them and told everybody that, great, we did 15 times our money. So be happy. We're not happy like that. So we looked at it and said, this is another opportunity and they're hard to find. Let's just create another business here. And so we did, capitalized it, spun it out at the time of the merger with the Swiss company. And it's based in San Diego, and it has 2 FDA approved products, and one that is a treatment for warts that the indication is not yet approved. And so we've been seeking the approval of the product to treat warts, which is a very large market opportunity. And there's no FDA approved treatments for warts. There's only surgery, cryosurgery, basically. So we spun it out. We built a management team, a board, a group of investors like yourselves. Trent had shares in Albion and spun to them and invested more money. And that's how we built the company to the point now where we are almost ready to conduct a final phase 3 pivotal trial. Our phase 2 trial was extremely successful. And we've been in the process, as you know, of raising the money to build out our new manufacturing facility, conduct our clinical, our contract manufacturing operation for the fill finish. That effort in today's market is brutal. Brutal getting it contracted, and brutal getting the contractors to actually commit to fixed prices. It's so we've been really laboring, but we've got that in. We had that in front of the board yesterday, so we're ready to move forward with that step in the process, which is essential to protecting the core business. And then the R&D piece will continue on when we've raised the rest of the money for the phase 3, and we've got some irons in the fire on that, and that's where we'll turn our attention now.
Cool. A question. I know, as you said, Nielsen was spun out of Albion. We all got our, pro rata piece. In 2016, there was a small, I think, a $5 million fundraise.
3.5.
Here we are in 2021. We've just done another large fundraise. How did the company get through the phase 1, phase 2 trials? Was it the other 2 lines driving the business?
Basically, when we spun it out, let's remember that we spun it out with about $2.5 million of cash.
Yeah.
So it started with $2.5 million of cash and no debt. It still has no debt. And it right now, before we construct these manufacturing facilities, and after we've done the most recent $8.5 million financing, we're at roughly $15 million of cash on the books. So we're going to spend probably $10 million of that on facility, contract manufacturing, and other in preparation for the phase 3. And then we'll need $20 million more for the phase 3. So what we've done is finance all of the R&D to date with cash flow, out of the company's cash flow. Now, the company's cash flow stopped in April of 20 because dermatology offices were shut down. And they didn't restart just because the government said, okay, you can open up again. It took until roughly this March for these businesses to get back up and running. And we were just looking yesterday at the 6-month, April to October run rate, and we're back above where we were before the pandemic. So
Good news.
the good news is that, and that's without any sales of our Spirusol product, any material sales. So the business has recovered nicely, and it's generating cash again. So it gives us great comfort to have a business that, while the upside is tied to R&D, we have pretty good downside protection in that we've got well-established products and cash flow.
Yeah. How big is this market that we're going after, with the phase 3 trial? I know we can't say what percentage, whether it'll pass or not, that's why we do these things, but it's not a new drug that we're bringing to market.
No, this is known to be efficacious and safe. However, as you've watched, you still have to prove it in a phase 3 trial. The numbers have to work out. And so we have to conduct this expensive trial to prove that we deserve a label that says it effectively treats warts. And we need that to convince the payors to reimburse the doctors for the treatment at the same time. So that's what we're about. And the market opportunity I mentioned was large. So we've done extensive market research. I think we've spent over $600,000 on market research, and the estimates are that the effective peak market for the product once it's approved is somewhere between 750 million and $1.2 billion. Greatly
for the value of the company or for the value of the product?
The peak year revenue.
Yep.
750 million to $1.2 billion. Now, what's hard to, and what really is the biggest variable is what's the effective pricing going to be? And you really don't know because we haven't gotten it to the market yet, and thus it hasn't been reviewed by payors for reimbursement, and that's the real key. Right now, we're selling the products off label with no marketing for about $300 a vial. And, we hope to sell it for a lot more than that once it's approved and reimbursed.
Yeah.
So that's the information we would have is that it's a big opportunity, whether you take the low end of the range or even below it, right?
Yeah, absolutely.
So that's what we're after. It's a big opportunity, and we need the approval to get to market.
Yeah, and let me ask you this, and I don't think I had prepped you for this question. If the phase 3 trials don't work out, we still have a cash flow producing business.
Yeah, we have a business with 70% gross margin. Millions of dollars of revenue, and we wouldn't be spending on R&D. But here's what would happen. If we fail to execute on the trial, there will still be somebody that wants to do it because the market opportunity is large and the efficacy is well known. So what could fail? We could fail to enroll patients that we need, 300 patients. We could fail to get them to see it through. And so it's the details of managing this that are critical. And that's where trials can go awry, is failure to enroll. If anybody drops out before the final follow-up visit, they're not counted. That's the way FDA looks at it. Can't count anybody. They don't care whether their warts went away or not, unless they come to that final post-treatment visit and it's certified.
Yeah.
It's like, it's like a vote. It's got to be certified.
Yeah.
So
let's not go there.
Well, anyway, it's a very formal process.
Yeah, one last question on that. I mean, essentially what we're looking for is, here's a drug that dermatologists feel can help cure warts. We need to do the full-on FDA phase 1, 2, and 3 trials. But at the end of the day, we're looking at a label change so that dermatologists can prescribe this and insurance companies will pay for it.
And we can market it to dermatologists and to the public as a solution that is better than the status quo. There's not the pain of cryosurgery, the scarring, and the recurrence.
Yeah.
And our product has been proven to treat multiple warts by injecting one wart, because it triggers an immunological response as opposed to a destructive technique. So cryosurgery, they have to carve on you for every wart. You may show in our trial, basically we only wanted people with multiple warts.
Yeah.
And most people present to a dermatologist with multiple warts. And so the good news is that we had great efficacy in the trial, a recent trial. So if we injected one wart, almost all the time, almost all of the patients, we got rid of all their warts.
Yeah.
And
so exciting. And it's funny, maybe the next time we have our webinar, I'll bring in one of our partners. We've got another company we're invested in that uses a cryo spray within the lungs to treat COPD and chronic bronchitis.
Interesting.
And they're freezing it away, and it's much better than what's normally done today, which is burning it and killing that area.
Right.
I had some follow-up questions. What's the formula? You said there ain't none. I'd ask you about the markets, but all of our crystal balls are in the shop right now. What do you see in the future for these two companies? Are these another 5 or 10 years, or these?
I think both of these companies will end up being sold to strategics. If you look at Nielsen, we're looking for partners now who want to market the drug and participate in the trials in exchange for, marketing rights.
Yeah.
And those, so we'll either convert it to a royalty stream at some point, or we'll sell it. Salon Loss is a company that we will sell at some point for sure. It will go to the person, to the investor or company that wants to have a 1,000-unit chain.
Yeah.
Because the number of stylists in the marketplace out there is staggering.
Yeah.
Just staggering.
Yeah. Talk about a fragmented industry, and that's what we're all always looking for.
Right.
I want to say thank you. And before we end our webinar, we do have a few questions in from our audience. Okay. The first one comes from, I guess, possibly a future colleague of yours, but she is not today. And you touched on it earlier. Sheila wants to know if there are industries that you avoid. You mentioned not getting into gaming and a few other things. Are there a few that you'd really like, that you're always looking for, or a few that you just want to stay the heck away from?
Well, we're not interested in aerospace or we're not interested in businesses where predominance of the revenues are infrequent occurrences, or at the end of the year, you can look around and see what those businesses are. But, we've owned everything. What do we own now? And what have we owned? We own a forensics company today that makes everything that goes into the police officer's kit that they drop down at the crime scene to detect and collect evidence. A couple thousand SKUs, average ticket $600. Very predictable business. Hard to grow the business, other than because it's a niche. It's a niche marketplace, but very profitable. We got into the salon business. We like businesses that candidly that women feel are near and dear to their hearts. So there are a lot of businesses out there that women are really loyal to. This happens to be one of them. We got involved in. We like businesses where you take a natural substance that you might buy it by the pound or the kilo or the truckload, but when you refine it down in a pharma facility, it's worth thousands of dollars an ounce. Those are some businesses that we have grown fond of over the years. We owned and sold a high voltage cable assembly firm that made every connector and cable that was used in large X-ray and MRI machines between the power supply and the actual gun. But these were cable assembly sets that were unique to most of the products. You get spec'd in, and then you just ride the product life cycle, and the business grows. And we made these for Navy ships and GE imaging machines, and it was a very nice niche business that we added onto with an acquisition in Europe. We've been in the adult long-term care business.
Yes.
And like that business, like the demographic trends, and it's a difficult regulatory business, difficult to manage, difficult regulatory environment. We are not afraid of those types of things. In fact, we got involved in one when it had a reputational issue, and we were able to bring a solution to the table there along with capital to not only solve the reputational issue, but get the growth track record started, and that was ultimately bought away from us. We've been in a number of businesses over the years, Gene and I, but they all share a common set of characteristics, and there is a strong element of predictability and necessity to the target audience, and loyalty, it is something that you know it when you see it, you know it when you talk to the customers, and they say, gee, Salon Lofts has meant so much to me in my business. And you see all those comments on social media, and you talk to an allergist, and they say, boy, your products at Greer have put my kids through college, bought our vacation properties, built our nest egg. I make all my money off of injecting your products in people to desensitize them from their maladies. So it is what it is when you see it, and we stay away from things where we either don't understand the stickiness of the business model, or there seems to be a lot of controversy about the products. The forensic business, the owner was in trouble with the U.S. government because he shipped product to China he wasn't supposed to ship.
Yeah.
We solved his problem and bought his company, but we are very sensitive to that regulatory environment.
Yeah.
And so you know, where we see we can add value, then we move in quickly, because his products were just loved by police forces globally.
Yeah.
And the Chinese wanted it too, because they're so good. But, you know, anyway, long story short.
Indeed.
That's what we're looking for, Elliot. And when you find it, you know.
Yeah.
You
No,
can
that's awesome. That's awesome. That's really all the time we have. We've had a pretty shy audience, so not too many, really no other questions. Although if people have questions, you know, email us, call us, we'll get you answers. We'll track Dave down. So thank you, Dave, for headlining the first Mathers webinar and providing, you know, your insights. And thank you to all of the attendees for joining us. We appreciate your time and hope you've enjoyed our chat with Dave. And if you have any follow-up questions, like I said, just let us know. And finally, as the webinar is nearly over and it will stop abruptly, all attendees will be shown a short survey in the browser. If you wouldn't mind answering these, we'd be greatly appreciative of that. And if you don't have time now, there will be a follow-up email that will provide those. Looks like we made it. Well, friends, I've enjoyed this webinar and look forward to bringing more guests to all of you. I want to thank you again and wish you all a good day and let you know that this concludes our presentation.
Thank you, Elliot.